How you doing, ladies and gentlemen? It's your host with the most, King Richard, once again, talking about stocks today, once again. Okay, so the first thing I want to point out and remind you of is this is not a special case. This is just your average run-of-the-mill, typical bear market that I'm explaining what happens last time, the time before, this time, so that you will know what happens next time, okay? Now, I didn't need any charts. I didn't need any candlestick patterns. I didn't need any of that stuff to know that the bear market rally was coming in my last video. What we talked about in the last stock market video, not the barbecue I had, was that a bear market rally was coming. Now, you see a lot of guys out there with their candlestick patterns and their charts and all that. None of that matters, okay? You know what's going to happen because you know the big picture. You know what's happened before. You know what's going on in the macro economy. The charts do not even dial it down to a more accurate prediction. I told you there was going to be a bear market rally. It happened the very next day. I told you it would last about 25 days, and that's where we're at now, which is why I'm making this video. So the first phase of these things is the realization of, oh my God, we're not in Kansas anymore. It could be the internet bubble burst. It could be the housing bubble burst. It could be Lehman Brothers, WorldCom, Enron. It could be a number of different things. It doesn't matter. What happens is people rebalance their portfolios. It's not panic selling that drops the market. It's people get out of high beta stocks that drag the market up into lower beta stocks, generally that pay dividends, because a lot of these funds are required to be invested, but they're not required to be invested in the stocks that go down the most. So they get rid of those, they rebalance, they get a little cash, and we have this first phase. After that's over, you're going to see a bear market rally. That's just what happens, and it happens in a number of different ways at a number of different times, not just bear market rallies. Going down and then a 50% retracement is very common when the futures are low. When the futures are high, the stocks pop up in the morning and they take a 50% retracement down. This type of thing happens over and over in the stock market, okay? So what I want to get to today is that here we are in this bear market rally, somewhere near the top. I cashed out on Friday and took a couple days off, actually, and probably take today off too. But we're at the point now where you have a really good opportunity to make sure your portfolio's balanced the way you want it. Do you want more cash? Do you want less cash? Now, the valuations are something you really need to think about. The valuations before all this happened, stocks were about 5% or so too expensive. Now stocks are probably 10% too expensive. So even though the prices are 15% lower, the earnings are so much lower than that, that today stocks are more expensive than they were when all this started. And you really need to keep that in mind, okay? Now, in order to really think about what's going on here, is you have to look at the big picture of how people do things, right? If your kid comes home with his report card and he says, and you say, hey son, hey Johnny, you know, how'd you do in school on your report card? And he says, oh Dad, I got a B in gym class. What do you expect science and math to be? Do you think all that's going to be straight A's? Or is he breaking you in slowly for the crappy grade in math and science, right? So the same thing happens with governments, with Federal Reserves, with you, your kid, with people. You wreck your wife's car, you don't come home and say, oh honey, I wrecked the car and we're out 50 grand, right? You buy some flowers, some chocolates, you say, oh yeah honey, I got in a little accident today. Oh yeah, how about, well, you know, the insurance company said it might be a total loss, but they're not quite sure yet. They're going to call me back on Monday, and here's some chocolates and flowers, right? So one of the things you have to start noticing now is that now they're changing their tune a little bit. They're breaking you into the second sort of phase of reality. You have the Prime Minister of Australia coming out today saying, okay gang, this is going to be much, much worse economically than we thought. Probably not worse than they thought, but worse than you were told. And you really have to keep that in mind, because that signals that people are trying to break the world in for the idea that this is really serious, that it's not a $1 trillion problem that's been given a $2 trillion solution. It's a $10 trillion problem that's only been given a $2 trillion solution, which is how it always works. The other side of that coin, the side of the coin that says, oh, it's just going to go up from here, you should buy stocks, says that government got it perfect for the first time in history. They told the entire truth to everybody, and they got it right for the first time in history. And the worst economic shutdown in the history of the world only caused a 7-week problem in the stock market. That would seem absurd to me. I guess you can believe what you want, and earnings and time will tell, right? Now, one of the things you want to watch for, and I've been saying this right from the beginning, and that is that nobody cares about 6 million job losses. And people ask me, they say, why is the market going up today? We have 6 million job losses. I say, because they're not 10. The same reason you can have a $50 trillion debt in America is because $50 trillion doesn't seem like a big deal when it turns into 500 trillion down the road in 30 years. Okay, as long as it's not 10, 20, or 30, nobody cares for now. Okay, so what you're banking on is either the no one caring train lasts forever and then the market keeps going up, or what I've been saying all along is that eventually what people thought of 5 or 10 million job losses, I want to say dollars, but 5 or 10 million job losses turns into 5 million last week, 5 million the week before, 6 million, 5 million before that. And since nobody's done anything about it the first time, second time, third time, however many times it is, I give it 5 at the most. But that means the rubber band has gotten stretched and stretched and stretched and stretched and stretched. And when everybody decides to care, because now instead of 5, the total is 30 or 40 or 60 or whatever it is, whenever people decide to care, I cared right from the beginning. But I'm not the market. The market is filled with a whole bunch of other people besides me. But when it does snap, it snaps like a rubber band, and it looks as though everybody cares at once, and they care retroactively all the way back to that first 5 million job loss situation. Okay, so that's what the next leg down is when the government start coming out and letting people know it's going to be a little bit worse. The job losses go on longer than people kind of thought, and there's a little more of them than they thought, and that one day comes along and boom, there it is, right? And just the jig is up for the bear market rally. Okay, now the other thing that can happen is it can sort of bounce around in a little range for a while until people care. It doesn't have to be a direct down slot, but that's something to look for when, you know, the 6 million comes out of the 10 million or whatever it is, and everybody freaks out, because they're not going to freak out over that one number. They're going to freak out over all the numbers combined. So I don't really expect that to happen today. I think it's going to go on a little bit longer. Okay, so one of the problems with the next leg down you really have to think about too is the next leg down is where it looks like panic selling too. And the reason for that is the next leg down is where you start to get real margin calls. We've already seen Ronin Capital get a margin call at the CME. They liquidated 100% of their assets. We've seen 2 oil company bankruptcies. And don't get fooled by the, oh, it's only a $25 billion bankruptcy. Yeah, it's a $25 million bankruptcy because the company was worth $50 billion and now it's bankrupt and all it's worth is $25 million. It is a big problem. And there's 2 of them, just the first 2. Okay, so you have to start looking at the big picture around you to recognize that this next leg down is much, much, much more likely to come historically and reality in what we're dealing with here than otherwise, okay? And the other thing I want you to really be aware of if you're a high dollar, high margin kind of day trader is that margins requirements can change just like that, okay? They're without warning. So if you let's say you have $100,000 worth of stock, the margin requirement is $33,000 today, and you're okay, that can change, and you wake up the next morning and your margin requirement could be $60,000 and you're unprepared for that. And that's why you have that real scary leg in the second leg downward, because that happens to people. they start changing the margin requirements as the margin gets more, or the stock market and stocks get more dangerous. You know, that will happen to stocks like Tesla, for example. You know, if Tesla were to take a big dive down, the margin requirements would absolutely change. They change the margin requirements on oil when they have problems and things like that. So it's all it all can be done at a moment's notice without any warning at all, and you're in a margin call, and that happens. Okay, so I want to talk too a little bit here about what kind of stock should you rebalance your portfolio to. Like the big guys, they're taking a stock like say Google, and they're switching it over to some sort of similar stock that maybe pays a dividend that they like better. You know, they might go with sell 100 grand worth of Google and buy 80 grand worth of Apple that pays a dividend and have 20 grand in cash. What I want you to be thinking about is, are you switching up your portfolio a little bit to COVID friendly stocks? Are you thinking, I've told you all the way along that this airliner crap, this cruise ship crap, is crap compared to Amazon. I told you Amazon would hit an all-time high next Thursday. I was a little bit late. It hit an all-time high on Monday. So I was, what, 7-9 days early or something like that. But the reason for that is because it's a good stock with a good company with a perfect business model for COVID. And those are the kind of stocks you always want to invest in. What is Warren, every amateur clown on YouTube's favorite guy is Warren Buffett. What does Warren Buffett say about the airlines? He said the best thing that could ever happen to airline stocks is if Orville and Wilbur had been shot out of the sky. It was a horrible business before COVID. Why would you want to buy it after COVID? Makes no sense. So think about stocks like Netflix, another all-time high because people are home watching TV. Zoom, Teladoc, Walmart, Nvidia. These are all fantastic companies who are all benefiting from the COVID virus. You want to say, well, maybe Wynn Casino will make the comeback of a lifetime, and won't that be great? Maybe it'll be Burger King instead of McDonald's. I'm going to invest in... No. Go with great companies. Don't go with crap just because it's cheap. Okay? Now I'll give you a little analogy. Okay? I was selling turds yesterday for $500. I've discounted them today for $12.50. Would you like to come buy some? Probably not. Okay. So here's some things I heard from these Clown Town people on YouTube. This one Australian lady is saying she's doing the exact same thing as she was before all this started. Isn't she smart? No. You do something different at the top of a bull market. You do something different in the middle of a bear market. You do something different at the bottom of the bear market. And you do something different in the middle of the next bull market. This idea that you always do the same thing is stupid. It's like saying you always wear the same clothes, whether it's hot and sunny, it's freezing cold and snowing, or it's raining. Okay, it's just stupid. Okay? Now, once again, the whole point of all this is to make sure that you're balanced, and not just balanced between cash and stocks, but balanced with stocks that make sense for the situation we're in, which is a COVID virus situation. And on that note, by the way, Amazon is a COVID-proof stock. It is not a recession-proof stock. So if we see a long, protracted recession and everybody runs out of money, people won't be able to buy stuff on Amazon. They can do that now, and they actually had to shut down their normal business to only ship, emergency COVID-related stuff. That's over, but it's not recession-proof, and you want to keep that in mind. It's a fantastic company, fantastic stock, all-time highs, not recession-proof. Okay. So I got some notes here. So once again, you want to be prepared for either direction, but weighted toward the direction that makes sense to you. Okay? And unlike a lot of these other clowns, I am giving you advice. I'm not having a channel called Financial Education and try to hide behind some asinine disclaimer. Ooh, I'm not giving advice. I am. I'm telling you, I'm advising you that you need to have cash because we're going to keep going down. More is better. But for most people, you want to have some equity exposure in the astronomically unlikely event that somehow this is the bottom of the next bull market and it's only going to go up from here. That is so unlikely, I can't even begin to tell you. But anyway, once again, we talked about this in the 301, I think, maybe 401 video. This is the most dangerous time for people with too much cash. This is the exact time when I told you that you want to, if you were in all cash now, you'd be tempted to get back in the market because it's going up. It's only 15% below its highs. You want to get in before it gets back to its old highs so you can get a little discount on no. This is a more dangerous time to be invested than it was before because the stocks are overvalued compared to 15% above these prices, and the governments, as I said, are now coming out giving you the second helping of how bad this is really going to be. It's just another fear of missing out trap. But if you're dead set on getting back in the market anyway, I want you to do it absurdly slowly. If you were planning on investing 1,000, invest 50, okay? And do it very, very slowly, because I promise you it's going to go rushing back down and you'll get much, much better prices when it does, okay? Now, this is also this is sort of the, the medium term I'm giving you, okay? We're close enough to the top of the bear market rally to where you can cash out everything you bought at the bottom if you want to. You're not going to miss too much upside, and you won't have to worry about when to sell when it comes crashing back down. It'll be all over and done just like I am, okay? And the reason for that is, like I said, people don't give all the bad news out at once. People will get sick of hearing minus 5 million every week. They'll get sick of the third month of minus 20, 30, 40 million. They'll find out someday on the news that there are 2,000 more businesses a week claiming bankruptcy than there used to be. That, this company, that company, the other company, big companies that you've heard of are having trouble and blah, blah, blah. All that's coming down the road, okay? And this, just like the first 5 million job loss, nobody cared. Nobody cares about this earnings season. Yeah, it's going to be bad. The numbers are going to suck, but nobody will really care about that because it's expected, right? Zero revenue, earnings of negative. Nobody cares. Nobody will care. What they will care about is the next earnings season after this and the guidance people give. And if they don't say this is all over, everything's wonderful, it'll be that same rubber band that snaps over the job losses that I'm predicting. It will be a rubber band of earnings that snaps when people finally say, okay, we were given it a few extra months, we were wrong, the economy does suck, and then you have that third leg down. Normally bull markets have 3 legs, so I'm giving you a little preview of what we'll be talking about down the road. And here's something that's really important I want you to consider too. During times like this, whether it's the internet stocks collapsing, whether it's the housing bubble, no matter what it is, all people are laser beam focused on the COVID virus. The COVID virus is not the only bad thing that can happen. Iran is still pissed off that we killed their general guy. Terrorists still exist. Other natural disasters come along. Okay, so you have to realize that we're in a very, very tenuous time, and you do not want to have all your eggs in the riskiest basket available. You really, really don't, okay? So in my last video, I told you the 2 things that men love the most, which are big flames and sex. I'm going to give you men another hint, and women, something to really think about here, okay? Is another prediction I'm making. And that is that once all this social distancing stuff is over and people get to mingle normally again, the divorce rate is going to skyrocket because both men and women both are going to want to cheat because they're so sick of the partner they've been stuck in the house with for the last 2 months, 3 months, however long it lasts. And my advice is don't ruin your life by getting a divorce or ruining your relationship. And that would be much, much worse than losing half your money in the stock market. So when this social distancing stuff is over, everybody goes back to mingling again, I want you to really, really be careful when all of these urges come to light, and they will. So there you go, folks. We're at near the top of the bear market rally. My estimation is we're going to see another leg down. It's not going to be too long from now, and it's going to be more and more serious the tighter the rubber band gets stretched and the more ignoring of the bad numbers there are. And these aren't bad COVID virus numbers. And here's something I've wanted to mention all the way along that I forgot to mention, and that is the Federal Reserve and the government cannot cure the COVID virus, and everybody knows that. But also, here's the thing you haven't heard anybody say, which is also true, and that is that curing the COVID virus does not necessarily cure the economy either. That's why this is such a precarious situation, because even if everybody, it's all dependent on how long this lasts. If this lasts too long, an absolute cure, curing everybody, we could still be in a very serious recession for a year or two, making this level of the stock market much, much higher than the level when it's over. So keep that in mind. Love everybody. Hope you enjoyed this video. And let me know what you think in the comments section. See you guys later.